ICOs, the ultimate guide to making bank or losing it all. Hello, crypto enthusiasts. Welcome back to BitsPuls, your one-stop shop for all things blockchain and cryptocurrency. Today, we're diving deep into the world of initial coin offerings, ICOs, a fundraising method that's been both a blessing and a curse in the cryptocurrency world. For those of you new to the crypto game, think of ICOs like a crowdfunding campaign on steroids. Startups with blockchain-based projects sell their own tokens, often at a discounted price, to raise funds and build their dream. It's a win-win, right? Well, not always. Let's break it down, shall we? What's the deal with ICOs? An ICO is like a digital gold rush. It's a way for crypto startups to get cash flowing by selling their own cryptocurrency tokens to investors. These tokens are like shares in the project, granting you access to their services or a piece of the pie, depending on the project. The idea is simple. Buy tokens early at a bargain price, hope the project explodes, and watch your investment skyrocket. But just like with any high-risk venture, there's a catch. How does the ICO magic work? It's like a carefully choreographed dance with a few key steps. 1. The birth of an idea. The team behind the project cooks up their vision, technology, and big dreams, then puts it all down in a document called a white paper. This document explains the project, its goals, and its roadmap. 2. Spreading the word. The team shouts their message from the rooftops using social media, forums, and even dedicated cryptocurrency websites to drum up excitement and attract investors. 3. Token time. The team designs their tokens, the lifeblood of their project. These tokens have specific functions and can be used for various purposes within the project's ecosystem. 4. The pre-sale. Some projects offer a pre-sale where a select group of early adopters can grab tokens before the main event. This helps raise initial funds and rewards those who jump on board early. 5. The main event. The ICO launch day arrives. Investors can purchase tokens using established cryptocurrencies like Bitcoin or Ethereum. This is usually a limited time affair with set token prices and contribution limits. 6. Smart contracts to the rescue. Many ICOs use smart contracts, self-executing programs that automate the process of sending tokens to investors once their contributions are confirmed. 7. Trading time. After the ICO is over, the project team works hard to get their tokens listed on cryptocurrency exchanges. This allows investors to buy, sell, and trade the tokens with other cryptocurrencies, adding liquidity to the market. 8. Building the dream. With the funds raised, the team sets out to build their project, developing software, building infrastructure, and forging partnerships to bring their vision to life. 9. Community love. Throughout the entire process, the team keeps investors in the loop through updates, social media, and other channels. This helps maintain trust and keeps the community engaged. 10. Launch day. The project finally launches, and users can access the services or products promised in the white paper. 11. The journey continues. The team keeps working hard, building the project and achieving their goals, aiming for growth and widespread adoption. ICOs, a history of innovation. The concept of ICOs can be traced back to the early days of Bitcoin. In 2013, a project called Mastercoin, now Omni, held the first ICO, raising over 5,000 Bitcoin worth around $500,000 at the time. This opened the door for other projects to raise funds through ICOs. However, it was the launch of Ethereum in 2014 that really kicked things into overdrive. Ethereum introduced smart contracts, which made it easier for projects to create and distribute their own tokens. This fueled the ICO frenzy, with projects raising millions of dollars in a matter of hours. While ICOs have become a popular fundraising method in the cryptocurrency space, there's been a decline in recent years, partly due to regulatory concerns and the growing number of scams in the space. The good, the bad, and the ugly of ICOs. Like any investment, there are both benefits and risks associated with ICOs. Benefits. High return potential. ICOs have the potential for massive gains, especially for early investors. Projects that hit it big can see their token prices skyrocket. Early access. ICOs democratize investment, giving individual investors the chance to get in on the ground floor of projects that were previously only accessible to venture capitalists. Portfolio diversification. ICOs offer a unique asset class that can diversify an investment portfolio, allowing investors to gain exposure to the emerging blockchain industry. Risks. Lack of regulation. The ICO space isn't as tightly regulated as traditional financial markets, meaning there's less investor protection and recourse in case of fraud or misconduct. Volatility: cryptocurrency prices can fluctuate wildly, sometimes within hours or days, meaning significant losses for investors who aren't prepared for the roller coaster ride. Scams: the lack of regulation creates a haven for scams, and investors need to be extra cautious to avoid falling prey to dishonest actors. Remember, the world of cryptocurrencies and blockchains can be intimidating for beginners. Getting comfortable with using a cryptocurrency wallet and navigating the intricacies of this space takes time and effort. Hashtag how to separate the wheat from the chaff. Research is your best friend when it comes to ICOs. Here's what to look for. The team: evaluate the project team's experience and track record. Look for individuals with relevant expertise and a history of success. The technology: is the technology behind the project innovative, solving a real-world problem, and scalable? The white paper: read the white paper carefully. Look for a clear and well-thought-out plan that outlines the project's goals, technology, and token distribution. The roadmap: a well-defined roadmap with a realistic timeline is essential. It shows that the team has a plan and the resources to execute it. The community: a strong and active community is a good sign. Look for social media channels, forums, and discussions that indicate interest and support for the project. Partnerships: strong partnerships with established companies or organizations add credibility to the project. Token economics: understand how the tokens will be used, their utility, and any incentives for holding or using them. Legal and regulatory compliance: ensure the project is compliant with regulations in your jurisdiction and has taken steps to protect investors. Remember, there are many resources available to help you research ICOs, including rating websites, forums, and news sources. Do your homework before you invest. Hashtag white papers: the guiding light. White papers are crucial in ICOs because they provide a detailed roadmap for the project. A good white paper is clear, concise, and well-structured, offering a thorough analysis of the market, competition, and potential risks. Here's what to look for in a white paper. Clarity: the white paper should clearly explain the project's goals, technology, and token distribution. Avoid technical jargon and make it easily understandable. Innovation: the white paper should highlight how the project's technology is innovative and different from existing solutions. Feasibility: the white paper should present a realistic plan for development and launch, addressing potential challenges and risks. Transparency: the white paper should be transparent about the team, their experience, partnerships, and any potential conflicts of interest. Be wary of projects with poorly written or vague white papers. A well-crafted white paper can provide valuable insights and help you make informed decisions. Hashtag the legal and regulatory landscape: navigating the maze. The legal and regulatory landscape for ICOs is still evolving, with different countries taking different approaches. There's no global framework, leading to a lack of clarity and consistency across jurisdictions. Some countries like Switzerland and Malta have embraced ICOs and created favorable regulatory environments, attracting blockchain startups. Others, like China and South Korea, have banned ICOs altogether, citing concerns over fraud and investor protection. In the United States, the Securities and Exchange Commission (SEC) has taken a cautious approach, stating that many ICOs may be considered securities offerings, subject to existing financial securities laws. This means ICOs must comply with registration requirements or qualify for exemptions. The lack of clear regulations can pose risks for both investors and projects. Investors need to be aware of the legal landscape in their country and ensure that projects are compliant with regulations.